Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. BNP Paribas, a trading unit, taking a third quarter hit from souring debt, adding to recent concerns about private credit. Deepak Puri of Deutsche Bank Private Bank joins us now for more. Deepak, good morning, sir.
Good morning.
Look, I think David Solomon did a decent job of drawing a very, very big line between systemic risk and credit concerns. There's still concerns, I think, about a turn in the credit cycle. Do you share them?
Maybe episodically, right? So we have seen one of these, idiosyncratic risks every now and then come out. For me, Jonathan, the biggest risk is this year we have seen two really big supply shocks. And we still don't know the full-term ramifications. I'm talking about tariffs and labor supply. So once you have those two, I think 2026 might be a better test case for these kind of supply shocks and their unintended consequences. As for now, I think, episodic news with regards to credit, I'll take it really episodically.
Well, at least one of them might be lulling this Federal Reserve into early interest rate reductions. The Fed seems confused at the moment. We know we've seen it in the data, massive step down in payrolls growth. Got that. What's behind it? Demand or supply? Which one is it?
I think labor market is one of those conditions where demand adjusts to supply in a way. So if the supply of, workers is reducing, I think demand is going to start adjusting to it. And what we are seeing is this automation drive from companies that is hurting, the overall supply. What is also a little bit disturbing is the government shutdown, because I think it sort of exacerbates the labor market conditions.
Typically, Deepak, as you know, and Anne-Marie's laughing, because typically we look right through this. It doesn't matter. It's a bump in the road. Growth comes back. Basically, it's growth delayed and not derailed.
Sure.
The longer it goes on, do you start to change your thoughts on that?
I think yes, primarily because after a while it becomes exponential in terms of the output activity. So the first few weeks, the consensus is 10 basis points of economic output gets reduced. But after a certain point, let's say this ends up being mid-November, you're going to start seeing more concerns with regards to the impact it's having on broader economy. And then obviously it'll have an impact on the labor market. So I would not be completely, negating the fact that yes, over the years, whenever we have a government shutdown, it tends to be, short-lived and painless. This time it might be different.
I'm only laughing because you say the word disturbing, which I also find disturbing. The market is creating fresh all-time highs, clearly ignoring it. Besides the impact it can have on the economy, how long could this Federal Reserve or investors go without economic data?
Well, they have shown tremendous resilience to drive their policy without much, but because they're using anecdotal evidence as to get a grasp on where the economy is. And I think even there is a government shutdown, crisis, let's say, quote unquote, there's so many other positives that are happening in the markets, Anne-Marie, that I think takes too much precedence over government shutdown. I think the fact that you are looking at an AI hyperscale capex spending guidance, which might come again a lot better than expected. You have a little bit of a framework between the US and the Chinese with regards to the trade and tariff. That could be potentially a game breaker, because within that trade and tariff, one of the uncertainties has been the Chinese one, because that's really where the bone of contention has been. And then last but not the least, the Fed. There is this expectation maybe end of QT. You look at the SOFR, 20 basis points over the Fed funds overnight rate. You can argue that there is some liquidity tightness where the Fed would be, want to ease some of that. So all these three things, I think, are taking much greater precedence over the government shutdown.
But these three things, it sounds like we have a tremendous amount of certainty on. The trade story seems more optimistic with China. We know that the Fed is going to cut, 98% chance the Fed is going to be cutting interest rates. So what gives the market potentially, or where do you see the market potentially having a little bit more of a cautious tone? In regards to what?
Yeah, I think from now till the year end, once these three things are not disappointed, right, there's no disappointment with these three things, I think the seasonality will take over. So from now till the year end, I would not be surprised if you see a little bit more of this risk taking, and then, investors chasing a very high rally market, which is usually the case. I think the biggest concern for me is really what transpires in the first half of 2026, where you are going to be going through a cyclical sort of softness in the markets, and now we'll get to know what is the worst outcome with regards to the labor markets, because we didn't have the data for the last 2-3 months. So in totality, what could potentially happen? And I think if this labor market statistics are similar to what we have seen in the previous years, where June, July was the weakness and then it started getting better, then it'll be okay. However, there is a likelihood that it might not be the case that way. And in that particular instance, I think the markets need to recalibrate to a much starker, economic reality that the economy is slowing more than expected.
Well, what do you think the source of that slowdown, or that softness, as you call it, for the first half actually is? And to what extent will it be offset by the massive tax refunds that I keep hearing about that are going to kick in early next year?
Right. I mean, it depends. I mean, we are thinking it's going to be with a 0.6 to 0.1%. Right now, you look at GDP now, the nowcast from New York Fed, everything is showing up with a 3 handle. So it's much better. But these things can change quite quickly. So I would not be surprised if you start seeing a below potential GDP number for the first half of the year. And on top of that, there might be some concerns about these credit conditions, these credit stresses that are developing, becoming a little bit more broader, default rates going up. So I think primarily that's one area of concern. And then last but not the least, I would not be, the lagged and varying effect of the tariff. I think the fact that we are having these bilateral MOUs does not necessarily mean that the lagged effect of the tariff rate, which is 5 times what the world is used to, is not going to have an impact.
Final question from me in the 40 seconds we've got less. Greater potential for higher stocks or lower bond yields in the first half of next year?
How about neither? I think because last time I came in, I said you don't want to be overly bearish, and the question was that the markets can go up and bonds could rally, and that was in early September. I would not be surprised if you see a little bit of a bond weakness going up, so the yields going up, and stock markets having a little bit of a recalibration come early parts of 2026.
Stay with us. More Bloomberg surveillance coming up after this. Stocks edging higher as investors gear up for a crucial week of earnings. Ohsung Kwon of Wells Fargo raising his year-end price target on the S&P from 66.50 to 7,100 and writing the following. We're out with a big call this morning, calling for an everything rally into year-end. Our call is to buy low-quality, junk, high beta, and small and mid AI CapEx beneficiaries. A full risk-on trade. Ohsung joins us now for more. Ohsung, good morning.
Good morning.
I mean, that's quite a call, so let's get into it. What's the source of this change for you?
Yeah, so we see about 5 potential catalysts into year-end. We're bullish. So those 5 are seasonality. Obviously, November, December has been the best 2 months for the S&P, but not just for the S&P, but especially for the laggers. After tax loss harvesting in October, we typically see laggers rallying in November through January. Number 2, AI CapEx. I think we're going to see another upper surprise in AI CapEx when hyperscalers report this week. Number 3, potential tariff refund. So IPA hearing is going to be next week. The ruling is probably going to be in January. And there's about 60% chance, according to betting markets, that it gets repealed. And if that happens, we're talking about $160 billion of tariffs collected being distributed to the economy, which is going to be huge reflationary. Number 4, the OBBB tax return. We estimate about $800 incremental tax return per filer this upcoming tax return season, which is going to be bullish for the consumer as well. And lastly, potential government reopening. That's going to be bullish as well.
Okay, so let's break down some of this. I'm going to let Anne-Marie handle everything to do with Washington, D.C. I want to ask you about tech spending. So the CapEx story and what we're going to hear from the major tech players on Wednesday and on Thursday. They're spending lots. Do they need to report some really robust revenue growth alongside that for investors to continue tolerating this?
I think for hyperscalers, as a group, we're not that bullish because they're the capex spenders. Their free cash flow is coming down, and historically, you want to avoid companies that are in an investment cycle, which is basically hyperscalers today. The areas that we're more bullish is really the capex takers, especially the smaller cap companies that are really starting to benefit from this hyperscalers capex increasing. The major players right now, even the capex takers, they're at full capacity. There are a lot of crumbles that are falling off the table, and those crumbles are huge for those smaller guys. So that's really the group that we like. We have a basket of about 25 smaller cap AI capex beneficiaries that we like.
Let's go to tariffs, because I think the IEEPA story is underappreciated right now in the market, and the fact that you can have north of $90 billion having to be repaid back to these businesses. But the Trump administration basically has other ways to get around tariffs. So doesn't that get rid of that reimbursement? Because companies are going to have to pay it, just it's going to have a different title to it.
Yeah, but I think into that event, potential event, that binary event, we're going to see some reflationary trade because investors will want to position for that potential repeal of tariffs. I think the knee-jerk is obviously going to be very bullish for equities, rates probably higher and gold higher on physical concerns. But in the medium to longer term, this could potentially create more uncertainty.
Then there's the shutdown. If the market is shrugging off now, why would they care when it reopens?
Yeah, I mean, government shutdowns historically have been non-events, basically. But coming out of shutdowns, we typically see the S&P rallying even harder. No news actually has been good news for the market because there's no data coming out and there's no negative catalysts for the market. Even if the government reopens, there's probably going to be about at least 2-week period where we still don't see much data. It's more going to be what companies are saying and how the third-party data is suggesting. So I think that's still a pretty bullish setup for equities.
Low quality and junk. What is low quality and junk?
Yeah, so unprofitable tech.
Okay.
So more speculative stocks, some of the laggers that have underperformed that are really struggling. So we're essentially pitching a catch-up trade into year-end because I think it's going to be a full risk on into year-end.
Do you need the Federal Reserve to come along for the ride and keep signaling more to come?
Yeah, I mean, I think Fed is basically a done deal. They're probably going to go on Wednesday. And if that's the case, I think Fed is probably, we are in a real easing cycle. So the Fed is done. It's more about fundamentals now. And, you know, some of the risks that we are seeing that have proven to be less of a risk than what we had expected initially.
This picture you're painting, I feel like, is the meme stock frenzy we saw. Are you expecting almost something like that?
We could see a little bit of that too. You know, we until last week, we were seeing some of that happening in some of the meme stocks and the retail-driven names. I think last week was a little weird that the setup itself was pretty unfavorable because last week, if you think about all the earnings that came out, it was mostly regionals and industrials, which were obviously facing more headwinds. There was no AI earnings, and we had the CPI overhang on Friday. So I think that setup, the calendar setup itself was a little shaky. CPI was obviously very positive. And into this week when we are going to hear from all the AI companies, we have the Fed, we also have US-China on Friday. So I think the setup is pretty favorable for some of the lower quality stocks.
If you have 7,100 for this year, what does that mean for your 7,200 target next year?
Yeah, we're thinking about that. We're going to revisit our 2026 numbers. I still see
sounds like it
more
has
upside.
to be higher.
Yeah, I still see more upside to that number.
We had a guest on the program that said maybe we could see a soft patch in the first half of 26. You must have heard him. He was on right before you. What gives you hope that this can continue through 26? I'm not going to pin you down for a new price target. We'll wait for the annual outlook. But what gives you hope that that's the case?
Yeah, I mean, it's really going to be driven by earnings. We still see a pretty healthy backdrop for earnings. We're forecasting 11% growth for 26, followed by another 12% in 2027. So if that's the case, even if multiples stay the same, we're talking about, you know, low teens return in equities.
I'm not going to question the earnings because every time I do that, Wednesday, Thursday hits in earnings season, the tech players come out and they knock it out of the park. So I won't question the earnings. I do wonder how you think about the rest of the world. The international stock story had its moment in the sun. The first quarter of the year everything kind of ripped and things have settled down since. Where are you on the US versus the rest of the world?
Yeah, I think US still looks more favorable in terms of the AI story. I mean, the rest of the world, we could potentially see a catch-up trade there too if we start to see the manufacturing cycle really turn. But the areas that we are more bullish are really around AI.
Is there one thing that makes you nervous? Given how bullish you sound, I mean, we've been through all the bull case. Is there one thing that just sort of niggles at you a little bit?
Yeah, I mean, I think hyperscalers probably because their free cash flow is coming down. And they are the biggest companies in the S&P 500. So if you start to see more of a rotation type of trade rather than broadening out with everything rallying, then that's not going to be good for the S&P at the index level.
Stay with us. More Bloomberg surveillance coming up after this. Katy Kaminski of AlphaSimplex Group writing, the rally in equities has been relatively broad-based with big tech slightly outperforming. Katy joins us now for more. Katy, welcome to the program. Jan Caffrey of JP Morgan kicked off the program with us and said you don't want to fight this bull market. Do you agree?
I have to agree. And actually, you have to start asking yourself the question, what are the things that could be a sort of a stop for this big rally that we've seen? And there isn't anything that's obvious. I think I am watching, though, what Fed commentary will be this week, just given the fact that we don't have data for future meetings. So I think that is one potential curveball. But in general, earnings are good, growth is good, and the trend has been very strong from a technical perspective.
Katy, that's the equity market. The equity market's pricing in a rebound in economic growth. I wonder what you think the bond market is pricing, because this rally, particularly the long end, coming out of the summer, has surprised many. What do you think explains it?
Well, I think, bonds have really been focused on sort of potential rate cuts and seeing more accretive inflation data is also very positive for bonds, especially on the long end. I think an interesting point is we haven't seen a steepener. We've seen sort of a pause in that particular move in bond movements, which means basically that you're seeing a flatter yield curve. So I think bonds are very focused on rate cuts, and that has been pretty consistent. But trend signals have not been very good at timing those moves in bonds, and there haven't been sort of very strong themes to follow, except for that bonds have been slightly up. So I'd say it's still a little tricky to trade bonds this year.
Katy, it's been tricky to track the correlations. Everything seems to be rallying at the same time. Stocks, bonds, and precious metals too, until very, very recently, when the gold trade started to unwound. Do you see that as an isolated story in its own asset class, or does it speak to something else happening somewhere?
Well, I think gold is something we really should watch because it's the only thing that's telling us something interesting right now. I think, you've seen this very strong gold theme for the past couple of months, and you have to start asking yourself how much of this is an overextended rally and, deleveraging out of sort of what has been a very profitable trade, and how much of it is a shift in sentiment about concerns. Because I often see gold as something that people use to hedge their concern for things like inflation. And, the recent moves in gold could give you pause that something might be changing that we haven't really understood yet.
Well, what could be changing? Is the market just feeling better about the geopolitical situation and the trade narrative coming from the Trump administration?
I think that's the case. So maybe it's a change in sentiment, but it also could be, and this is the one kind of wild card question, is like, let's say that we have a little bit of a pause from the Fed that would affect real rates, which also affects gold prices. So I think, gold is an interesting one. It's the only thing that's kind of moving in a different direction right now. So some of it could be sentiment drifting more positive. That means everything's kind of in the same direction. But, we'll have to see. It is something to pay attention to.
Katy, there's a lot of catalysts just in this week alone. We have tech earnings, the Fed meeting, and of course, the president sitting down with Xi Jinping. What are you most acutely focused on?
I would say I think the rhetoric around China has been very important. I mean, you saw those moves. It has the ability to move the market, and it is a theme that the market has been concerned and focused on. I mean, obviously earnings are important, but I think, some resolution of some of the volatility we've seen around that has been received very positively by the market. So I think that's something we're watching. We're also seeing in commodities, take a look at soybean prices, for example. And so you could see, other moves as a result of that particular discussion.
Katy, dangerous territory for me to ask this question and to wrap up this conversation with it. Is there a credible bear case going into 2026? And if there is, what is it?
I think this is a really hard one. And, I love to be a bear, but, you're not seeing it in the data right now. And I think gold was one of the themes that was a little bit of a hedge position, I'd say. So I'd say right now there's really very little signals that suggest a bear move. I do think the Fed potentially pausing due to lack of data could, kind of cause some stress for the markets. Is it a bear case? I'm not sure. We'll just have to see. But you're right. There's not a lot of bear signals out there.
Stay with us. More Bloomberg surveillance coming up after this. The president praising new Japanese Prime Minister Takaichi and offering her, quote, anything you want to strengthen diplomatic ties. The leaders signing trade and critical minerals deals, but the details remain vague still.
This could not have gone better for Japan. I know we're still waiting for some details when it comes to some of these specifics on trade and on business investment. But you have to think, you are a brand new prime minister, the president of the United States coming over after dealing with incredibly, at times, difficult rhetoric when it comes to trade. He's saying, I will go above and beyond for you, especially when it comes to defense. So as Kellyanne Shaw was saying, she just got back from Japan. What she was hearing from executives and some individuals close to the government, a little bit of nervousness with the president coming over. For Japan, this couldn't have gone any better.
It's a pretty interesting sequence, isn't it? Tie up things with your allies in the region, in Asia, and then move on to South Korea and sit down with the Chinese leader. Just how much leverage has the president got? How much, to what extent is this deal already signed and done?
This deal, it sounds like from what Kellyanne Shaw was saying, who was there at the table during Trump 1, is almost done. There is a framework. Will that framework be made public? This does feel like a work in progress. And as Kellyanne said, it's really about managing this relationship from this point on, potentially not this grand bargain that a lot of people thought we would maybe get with Beijing going into Trump's second term.
That's the latest on trade. Let's turn to tech. Qualcomm shares up slightly after hitting a 15-month high on Monday. The jump following the unveiling of new chips and computers for the AI data center market as the company tries to challenge NVIDIA. Their stock is down this morning by 1.4%. And finally, Goldman Sachs CEO David Solomon saying he doesn't see any systemic risk looming in the credit market. Solomon describing recent losses at regional banks as idiosyncratic events that serve as a reminder to stay vigilant about underwriting standards. David Solomon catching up with Jumana Basechi over in Riyadh, Saudi Arabia. We're going to hear from Jumana a little bit later this morning when she sits down with the JP Morgan executive, Mary Erdos. Let's turn to the shutdown. Democrats now facing pressure from the largest federal workers union to put an end to the weeks-long stalemate in Washington. Joining us now is the Republican Congressman French Hill of Arkansas. Congressman, welcome back to the program, sir. We've had a couple of guests talk up maybe this ending at the end of November. What are your constituents saying to you, sir?
Well, John, it's nice to be with you. Well, this Schumer shutdown has been a disaster while they try to get $1.5 trillion in new spending, undo all the reforms to the Medicaid program, just to name two items. We're putting farmers at risk in my state. I met with farmers last week. They're desperate for the Congress to come back into session, work with Secretary Brooke Rollins on a particular effort to have a stopgap measure to help them between now and the benefits in the great big beautiful bill in the next fiscal year to help our farm economy, which is in desperate shape. We have record Chapter 12 bankruptcies in Arkansas. I've got 400 National Guardsmen that are on furloughed and on unemployment this week in my district. So my best advice is that if Schumer would release these Democratic senators, let's get the government back open and continue our negotiations on appropriations.
Congressman, do you think that Republicans should all be back on the Hill to potentially await maybe a single funding measure to either pay those individuals like you're talking about in your district that are not getting paid, or federal workers?
Well, the Senate has put those bills on the floor with the senators right there, and Chuck Schumer has blocked the motion to proceed to pay federal workers to take other targeted actions to pay military employees. I mean, this is the kind of shameful rhetoric and approach that Chuck Schumer has taken. He's holding federal employees and state employees that are funded by federal grant programs hostage, and that's why the employee union of the federal government spoke out yesterday. But that's what I hear from folks in my district every day. The House is at call. We did our work 5 weeks ago. We're on call. We can be back here in minutes if the Senate moves to open the government. And as this drags on, we're just going to be confronted with another vote on the continuing resolution in just a few days. So we've missed all this time of important work on agriculture, on banking, on reviewing housing policy, all because Schumer wants to spend $1.5 trillion more and do away with all the reforms that we made in the Medicaid program.
I guess my question is Speaker Johnson and you and your colleagues willing to vote for some of these one-off spending bills if the Senate was able to pass it?
Well, look, the Senate, what needs to happen is Chuck Schumer needs to reopen the government. That's what needs to happen, Anne-Marie. That's the easiest thing to do. 5 weeks ago, we offered a clean CR that had Democratic support. You have Democratic senators saying that Chuck Schumer is wrong. You have Democratic House members saying that Chuck Schumer is wrong. So he just needs to get with reality and recognize that we should be opening the government, and then we can continue the work on FY26 spending.
You mentioned agricultural and some of the farmers that are suffering right now. A lot of that has to do with the fact that in retaliation to the Trump administration's tariffs, China is no longer buying soybeans. Well, that we're expected to change today or this week. How is your district reacting to what is going on in terms of trade relationships this administration is having with China?
Well, the principal challenge to our row crop farmers in Arkansas is that we're potentially entering the fourth year of bad finances. $1.5 billion in losses is forecast for this farm year. That's the 3 years, and we're getting ready to enter a fourth year, brought about by higher costs due to the inflation during the Biden administration and the inflationary effects of Russia's invasion of Ukraine. These have crushed the cost side of producing a crop, and then prices have stayed fairly reasonable all during this period, but we've had surplus crops around the world. You're right that Joe Biden did not enforce Trump's agricultural products deal in his term, and that only about 60% of the soybeans that China promised to pay and Trump won, those purchases were made. So I hope that President Trump can get that market back open for American growers. But we also have to recognize that 4 bad years in a row is going to put the banks in trouble and the farmers in trouble. Before I was in Congress, I was an agricultural lender. I know about how challenging it is with 2 back-to-back losses, but you do a third or start a fourth, you're going to put a lot of farmers out of business.
Hey, Congressman, this is a slightly uncomfortable question. I understand that because of what this business means to the people of your state. But at the moment, the U.S. is making, I think, a well-articulated decision to de-risk from China. That would therefore, in some ways, make it difficult to rely on China being a buyer of anything for the foreseeable future. Do you think that's something we have to reconcile with farm production in this country, that we can no longer rely on the Chinese buyer, even if we get some temporary relief and a soybeans deal this week?
Well, I think that's why you see Secretary Bessent and Secretary Lutnick emphasizing soybean markets all around the world besides China. We don't want to ever in business put all your eggs in one basket, and we've been very dependent on the Chinese market, as you know, for the past 3 decades. But we have to recognize we've got to open up other markets around the world. We've produced the best soybeans in the world at the best price, and we have the best farmers, and so we just need to make sure that we diversify that market, because you're right. Our farmers are at risk as long as we're in the middle of a de-risking strategy from China. But that's not just in ag products, but across the board, obviously.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.